What I'm going to do here is I'm going to quickly show you how you're going to apply this if you were using Microsoft Excel and just picked out a company. So we're going to do, I already started to do it here, but I'll go back a little. We're going to look at Under Armour. And the company filings, sec.gov, Edgar Company Filings, enter the name of the company. You can see that I've done it already. And I enter filing type 10K. And then I click on Interactive Data. And you can see here, View Excel Document. And then Edgar will just then you could just download the financial statement. Next thing that I'm going to do is I'm going to open the financial statement in. I assume that if it's just from the SEC's website, then it doesn't contain a virus. That's probably not a good assumption. Anyway, I take a look at the balance sheet, and I'm going to make a new column here. Actually, I'm going to make two new columns for operating. Just to take a look at whatever the operating balance sheet is going to be like. So the operating items, as we know, would be accounts receivable, inventory, prepaid expenses, property and equipment, goodwill, intangible assets, and deferred income taxes. So total operating assets would be the sum of these, or 3,596,000. It's really 3 billion. For 2016, for the prior year, I can really just take the same formulas because the same items that are operating this year would have been operating last year. And so I have a separate column that would show all the operating items. For liabilities, revolving credit facility to me sounds like a financing activity. Accounts payable, on the other hand, is accrued expenses is operating. Other current liabilities, I would have to see what they are, but I'm going to assume that they're operating. Usually with other current, I assume that it's operating. With other long-term, I'm never quite sure. In this case, I looked at it and it appears to be operating. You have to see if it's something that is just a normal debt type of operation, debt type of item, or if it's related to operations. That would be key. So here are your figures. And I'm going to make a new sheet here so that I can keep track of everything that's going on. And I would have, let's see here, beginning, ending, and operating assets, operating liabilities, so my beginning operating assets are 3283. My ending operating assets are 3596. My beginning operating liabilities are 796,043, and my ending operating liabilities are 1070. Net operating assets would be assets minus liabilities, or 2487 and 2525. Next, I need operating income. And this is where things get kind of sticky because of the new Tax Act. You can see that the company, like most company, took a huge loss on income taxes. So even though you can see they lost money, but even so, they still had income tax expense, which is incongruous because if you lost money, then you should have an income tax benefit. The reason why they had this was because of the new Tax Act. So we're going to have to tease this out a little bit, and I'm giving everybody separate guidance on how to do this in general. The way you would do it is you need to look up the tax footnote and see what their effective tax rate is. So in this case, I go to, let's see. Here we go. Here's the tax footnote over here. And you can see that the effective income tax rate, the federal statutory rate, effective income tax rate is in the most recent year, I'm looking at this in a kind of a weird way, but it's 33.8%. It's easier if you look at it in the PDF. So their effective tax rate is 33.8%. You may also want to look at the state income tax rate. I'm going to save the trouble to do that. Is 0.338. Now let's go to the income statement and figure out net operating profit before taxes. This is not the income statement, obviously. Here it is. So that would be revenues minus cost of goods sold minus selling general and administrative, and I'm not going to include restructuring and impairments. So I'm going to get net operating profit before taxes of $151,892. And then my taxes actually I'm going to do it over here. So net operating profit before taxes was equal to, go over here, $151,892. The effective income tax rate is 0.338, so the provision for income taxes strictly on this would be 151,892 times 0.338, or 51,339. And therefore, NOPAT would be equal to 100,553. Now, to compute return on net assets, net operating assets, you would take NOPAT of 100,553 and divide by the average of net operating assets in order to get 4%. Now you're probably wondering, how would I disaggregate that? I'm sure you're wondering that, right? So we have two components of it. One is net operating profit margin. So we got to get sales in here. So I'm going to put it over here. Sales revenue, according to the income statement, was $49.76. And therefore, net operating profit margin would be equal to NOPAT divided by sales revenue, or a very pathetic 2%. The other thing we have is NOAT, net operating asset turnover. That would be equal to sales divided by average net operating assets, or 1.98. And then what you'd want to do here is you want to make sure that these two, net operating profit margin times net operating asset turnover, is going to be equal to return on net operating assets. And as you can see here, it is. So the math works. So now we can disaggregate return on net operating assets into its components of net operating profit margin and net operating asset turnover. And this is, looking at the numbers now, you can see here that it's a little bit troubling because these numbers are very, very low. And we usually don't like to have low numbers. So what I would do here is I would look at this income statement again, and I would see what else could be going on, and is there better profit in previous periods. And you can see that there was. So they had it appears that a big piece of the problem is this restructuring and impairment charge, but it's not part of my problem because it wasn't a problem last year. So what you want to do is you look at the prior 2 years and see that they were significantly more profitable, and therefore that may have some. It looks like it was a bad year for them. Let's recalculate NOPAT last year. So you can see NOPAT last year I should say, let's calculate it here. Net operating profit before taxes was 417, which is better in 2016. And in 2015, it was 408, which is also better. So that would be a higher number, and that would be encouraging.